Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're starting with some intriguing expert predictions for the Greater Toronto Area housing market in 2025. According to a recent report, potential interest rate cuts and changes to mortgage rules could accelerate the market's pace. It's a forecast that has many in the real estate community buzzing with anticipation. Economists suggest that the Bank of Canada might lower interest rates in response to evolving economic conditions, which could make borrowing cheaper for homebuyers. This, in turn, might stimulate more activity in the housing market. While some experts believe that this could lead to increased demand and potentially higher prices, others caution that the effects might vary depending on other economic factors at play. In addition to potential interest rate adjustments, there are discussions around modifying current mortgage regulations. Some industry leaders are advocating for changes that could make it easier for first-time buyers to enter the market. These proposed changes include adjusting the stress test rules and increasing the amortization period for borrowers. If implemented, these modifications could provide a significant boost to the housing market, making it more accessible for a broader range of buyers. However, it's important to note that these are still just predictions and proposals. The actual impact on the market will depend on a variety of factors, including government policies, global economic trends, and local market conditions. As always, staying informed and prepared is key for anyone looking to buy or sell property in the coming years. In today's news, we're taking a closer look at the growing concerns around Canadian mortgage renewals and the phenomenon of empty condominiums in major urban areas. According to a recent report, banks in Canada are preparing for an increase in mortgage delinquencies as many homeowners face upcoming mortgage renewals. Andrew Chang, a noted financial analyst, has highlighted that the potential rise in delinquencies is largely due to the economic pressures that homeowners are experiencing. With interest rates having fluctuated over the past few years, many homeowners who secured low rates initially may now face higher rates upon renewal, potentially straining their financial situations. In addition to the renewal challenges, there's a growing issue with empty condos, particularly in major cities like Toronto and Vancouver. Despite a surge in housing supply, many of these new units remain unoccupied. Some experts attribute this to the high prices that are out of reach for average renters, even though Canada added a record number of rental units in 2024. Interestingly, this trend of empty condos is not only a concern for homeowners and renters, but also for city planners and economists. The high vacancy rates in these urban areas could have broader economic implications, affecting everything from local businesses to city tax revenues. It's worth noting that while some potential interest rate cuts have given Toronto area homebuyers a sense of optimism, experts caution that these cuts may not be the complete solution to the issues at hand. The complexities of the housing market, including mortgage renewals and vacant properties, require a multifaceted approach to address. As we welcome the new year, it's an ideal moment to reflect on our financial habits and ensure our credit profiles are in optimal shape. This can be particularly advantageous when aiming to secure the best mortgage rates available. Let's explore some practical credit tips to help you boost your score and position yourself for financial success. First, let's talk about managing your credit utilization ratios. Many people think that paying off the statement balance in full each month is sufficient, but there's a bit more to it if you want to truly improve your score. Aim to pay your balance in full at least 3 business days before your card provider issues a statement. The reason? Credit card issuers report your balance on the statement date to major Canadian credit reporting agencies, such as Equifax and TransUnion. These agencies consider your utilization rate, which is the percentage of your credit limit that you're using. For instance, if you have a credit card with a $2,000 limit and your balance is $1,500, your utilization ratio is 75%. Paying off the balance before the statement is issued can significantly lower your utilization ratio, thereby benefiting your credit score. Another tip is to accept offers for increased credit limits from your card providers. While it might seem counterintuitive, a higher credit limit can actually strengthen your credit profile by reducing your utilization ratio. For example, if you owe $1,000 on a card with a $5,000 limit, your utilization is 20%. If your limit increases to $10,000, your utilization drops to 10%. This lower utilization can boost your credit score, as percentage utilization accounts for 30% of your credit score, according to Equifax Canada. It's also important to think twice before closing any credit card accounts, especially older ones. These accounts contribute positively to your credit profile by aiding your credit age and utilization ratios. If annual fees are a concern, consider downgrading to a no-fee card to maintain the account's history without the additional cost. When dealing with disputed charges on your credit card, a proactive approach is essential. Even if you believe the charges are incorrect, paying them off while the investigation is ongoing can prevent interest charges and late payment marks on your credit report. This ensures your credit profile remains intact while the matter is resolved. Finally, when it comes to monitoring your credit report, prioritize the major agencies like Equifax Canada and TransUnion Canada. They provide the most comprehensive and accurate information. However, remember that any report you access yourself will not be as detailed as the one a lender sees during a formal hard inquiry. If you notice errors in your report, request corrections from these agencies, particularly for significant inaccuracies such as incorrect personal information or unrecognized accounts. In conclusion, understanding and managing your credit profile is crucial in securing favorable mortgage rates and achieving your financial goals. By following these tips, you can enhance your credit health and set yourself up for success in the new year.